Welcome to Financial Repression Authority's Roundtable Insight, where the best fund managers, economists, and industry leaders discuss the key investment issues and challenges in the current macroeconomic environment.
Hi, welcome to FRA's Roundtable Insight. This is Richard Bernoulli. Today we have Peter Boockvar, Uli Kortsch, and Yra Harris. Peter is the Chief Market Analyst with the Lindsay Group and the Co-Chief Investment Officer with Bookmark Advisors. He has a new newsletter product called The Book Report, spelled B-O-O-C-K, report all in one word.com. It offers great macroeconomic insight and perspective with lots of updates on economic indicators. Uli is the founder of both the Monetary Trust Initiative, MTI, and Global Partners Investments. He has worked in over 50 countries, written a bill for Congress, and conferred with approximately 15 national presidents, ministers of finance, and ministers of commerce. And Ira is an independent trader, in the past hedge fund manager, analyst on global macro areas, consultant, has been trading foreign currencies, bonds, commodities, and equities for about 40 years, was CME director from 1997 to 2003. Welcome, gentlemen.
Hi there.
Hey, thank you.
So I thought we'd begin with the discussion as a leeway from our last week's focus on the Swiss National Bank in terms of what's happening there, financial alchemy, how they're trying to keep their currency weak in the face of a strong uptrend, and using that opportunity to buy equities around the world. Different from other central banks, as for example the Federal Reserve or other central banks that may be using the quantitative easing programs for purchase of financial assets like bonds or other currencies. Bank of Japan has also been doing this as well in terms of the Swiss National Bank buying of equities. Does everybody see this as a trend, and what are the effects on the equity markets worldwide? Peter, do you want to begin?
This is something that the Swiss National Bank has been doing for years now. That's why they have interest rates that are deeply negative, all because they're afraid of the negative economic impact of a stronger Swiss franc against the euro. But the Swiss bank is about to get lucky, because the ECB now has decided it's time to take a step back from their extraordinary policy. So maybe it'll be a timeout with respect to the Swiss and what they've done, fighting tooth and nail to prevent a rally in the Swiss franc. And yes, they have become one of the larger shareholders of a lot of different companies with all the money that they've printed, trying to find a home somewhere. They've essentially become their own S&P 500 index fund.
Ira, you mentioned they were behaving as a hedge fund also overall.
Yeah, and I think that's what Peter really, I mean, they're not even I guess they are a sovereign wealth fund, but unlike Norway or Abu Dhabi or Singapore, the Swiss, the only thing that they mine is a printing press. So they're able to crap this out of generally thin air, or it's the greatest act of alchemy we've seen, because it's not like they're earning to do this. They're just merely printing funds, and you got to give them their due. The world keeps taking it, and they keep printing it, and they're buying truly good assets. Nothing says it more than Apple and whatever else their portfolio. Peter, right on time. Target, it is, and as Uli brought up last week, Peter, that the Swiss National Bank is a privately held institution. There are shareholders, and I lamented the fact that I did try to buy some SNB stock many years ago, and they wouldn't let me for some reason. But it's been a very nice holding for a lot of people.
And Uli, you've done some consulting work for central bank policy for the Swiss National Bank. Your thoughts?
Let me be the bad cop in this conversation, and let me get away from interest rates and talk about currency for a minute. I'd like to see a study, and maybe I'm bringing this up because maybe one of you has, whereby the effects of the currency transactions that we have seen are actually visible within a country. If you think of what we're doing, or what the Swiss National Bank or Japan, or I mean, it's basically the whole world is trying to do is everybody's going around trying to weaken their own currencies. Basically, what we're doing is we're taking the wealth of the country and moving it to exporters, because everybody loses because the currency that I hold has a certain value with respect to the rest of the world when it comes to imports. And I lose some of that value. Who gets that value? That value goes to the exporters. The exporters aren't just corporations, they're also workers. And so what is the gain versus the loss on a national average? Because I remember a paper that I saw quite some time ago where the GDP change actually was counterintuitive, whereby currency strengthened and the country as a whole does better. Have any of you seen a paper that shows the relationship between the trickle down from the workers and the corporate portions of the economy that gain through a weaker currency versus everybody else that ends up losing? How's that?
Well, I don't think there's anything definitive on that, but I agree with you that the concept of weakening one's currency and somehow that's going to lead you to the promised land, I think is tremendously mistaken. And all you have to do is look at Japan and see their experiment over the past, since 2013 with Abenomics, of weakening a currency and what that does. So yeah, maybe and on a dollar basis, Toyota makes a bit more money, but the consumers certainly suffer as it depreciates their purchasing power and their standard of living. So I think it's an idiotic policy. To me, the ideal currency policy is having a stable one, not one that's too strong, not one that is too weak, just having a stable one. But the problem is that it's almost, if somebody picks a fight in a bar and somebody pushes one person, well, it's not just a fight with those two people, because that other person bumps into somebody else, who bumps into somebody else, who bumps into somebody else, and all of a sudden there's a huge skirmish.
Peter, I think that's right. And Uli, I think if you look at the work of Michael Pettis, who now hangs his hat in China, but he's done a lot of work about that, because I think we have to go back to that period, that discussion again, as we've talked, Richard, as you've led this discussion about, is having a reserve currency an exorbitant privilege, or Michael Pettis would argue it's an exorbitant burden, because as you rightfully say, in any type of policy like this, there's winners and losers. If you drive your currency lower, as you rightly point out, your consumers are going to be losers, especially if you're buying a lot of imports, because the cost of imports is going to go up.
Right.
Yes, and who's going to benefit? So, I think this is a discussion that's also plaguing Germany. Germany likes to take the moral high ground and say, no, we're just doing it right. But it still is a pretty established policy that they promote exports as the driver of the economy. But that promoting exports and keeping a weak currency, of course, does burden the purchaser of imported goods from others around the world. So, and I think Pettis has really covered this very well. I think his most recent book, The Great Rebalancing, has a lot to do with that. And that's what made the China policy so interesting. And I know you're going to lead our discussion about Xi and Trump. But if China were to go to a consumer-based economy, they would do much better, of course, with a stronger currency. So that's why, to me, the yuan is such an important barometer for what China wants to do. Because if they're, in fact, making the shift to be a much more domestically oriented economy to soak up all that excess capacity, then they should promote a stronger currency, because it would be better for their consumers.
It's simply another form of financial repression. Richard, does that have something to do with some name?
Yeah, exactly. And I guess from currencies as well, that can lead us into a discussion on the U.S. dollar in all of this. So what do you see as the effect happening on the U.S. dollar, given potential trends in trade policies of the U.S.? Tomorrow we have the visit of China. happening, so the thoughts on that, where the dollar could be headed, Peter?
Well, I think trade flows are actually a smaller percentage of the daily moves in currencies. I mean, the foreign currency market is $5 trillion a day.
Right.
So what's 500 billion in the U.S. of a trade deficit? It's nothing. I think what's going to drive the dollar is real interest rates, not nominal interest rates. I mean, here we are. The Fed started raising rates in December 2015, and looking at 5 years out, the 5-year real rate, the day after they raised rates for the first time, was 50 basis points, positive 50 basis points. Here we are, 3 hikes later, and the 5-year real rate is minus 19 basis points. So anybody who looks at nominal rates to determine where they think the dollar is going, or where gold is going for that matter, is not really looking under the hood. And I think it's the deep decline in real rates is what's kept the lid on the dollar, which is really at a level no different than where it was a couple of years ago. I mean, look at everything that's been thrown at other currencies. Look at everything that's been thrown at the ECB. Deeply negative interest rates. Not QE, not just in the sovereign bond land, but corporate bond land. And Japan experimenting with negative interest rates. And all the Bank of Japan balance sheet. And these currencies have stopped going down. And it says a lot about the flaws of the U.S. dollar and the impact that negative real interest rates has, notwithstanding the rise in the Fed funds rate.
You know, Peter, I think that's such a great point. And it's really, to me, having done this for 40 years come May, that used to be significant, and that would be one of the great underlying fundamentals. Because we saw the Brazilian real at one time go from 2.5 not that long ago up to 4, and now, of course, we're back to 3.2, and they had the highest real yields in the world. I mean, to me, it was preposterous, and yet the currency still got hit. And I think because that's one of the changes in the market. Because I kept looking at going, at some point you got to come and buy this because it's real yields, as you rightly say, not nominal yields. But in this world of algo, high frequency trading, that really is devoid. All the movement that we get within a 24-hour period that is driven by headlines are really devoid of the underlying fundamentals. And I think your point is just so right on. And and guys like me who are global macro traders, we keep waiting for the fundamentals to reassert themselves. And you just reasserted it into the argument because it's not U.S. rates are negative now. They're negative. Right. As you rightly point out to 5 years, okay, so maybe we get to 7 years and they're probably about flat. 10 years, you're probably earning about 30 basis points. But relative to the vast amount of debt, to the vast amount of dollars rolling around the world, nominal rates, real rates in the United States are negative. And that will bear, I agree with you, will bear on the currency. When? I don't know. I used to have a much better handle on the time frame of it, but today, in the way the world operates today, I don't.
Yeah. As you point out, Peter, in your recent book report, that on the real 5-year yield, it's at negative 0.11% versus the plus 0.43% on the day the Fed started hiking rates back in December of 2015. And that's already contributed to a 16% rise in gold.
Yeah, I mean, just remember all the people that were bullish dollar because the Fed's raising interest rates, and that were bearish gold because the Fed's raising nominal interest rates. And it was just a very superficial analysis of people making a decision. And I think the market showed them what really they should be looking at more than anything.
Yeah, that's a point very well taken. And Peter, that you bring that up and you make that point, I respect that view. I mean, I sit here, I'm down in Arizona I'm still for the winter, but I've met a group of guys, all successful businessmen in their late 60s, early 70s, and we discuss these issues and the way that they see the world and how do they protect themselves. And I think when Peter brings that up, it's very difficult. It's very difficult if you've been a saver investor for the last 5 or 6 years to really find a way to protect yourself in this environment. Because if you put your money into 2-year U.S. government treasuries, you're with nominal real yield negative, you're losing money, and that's where their safety zone is. So where do they go? And I think that point by Peter, and they keep asking me, what do you do? And I said, I'm really in the same bind as you are. I can trade my way through it, but how do I invest through it is a whole different story.
And just to quantify that, according to the Fed's quarterly flow of funds, there is about $11 to $12 trillion sitting in essentially zero interest rate bearing savings accounts, whether it's savings accounts, money market accounts, checking accounts. And if it was just yielding 1%, you're talking $100 billion extra of interest income. Multiply that by the 8 years of zero interest rates, and you're talking about savers that had been deprived of almost $1 trillion. Through this monetary policy that the Fed said was going to improve growth.
But we know but Bernanke and Yellen both gave us the answer to that, which was stop your crying. And even Carney and Draghi says the same thing. So they must exchange his view at the G30 meeting that I'm not invited to, which is stop your crying. Your grandchildren have jobs. Your neighbor have jobs. So yeah, we know we've been screwing you, but stop crying because society as a whole is better.
Right. Yeah. They'll argue, well, it was basically a giant wealth transfer from savers to bank balance sheets and borrowers.
Right.
Right. Which brings us back to Uli's comments about when you make a policy extend a strong dollar, weak dollar, as all these policies are written about, and I go, of course, to Carmen Reinhardt's work on financial repression, which is it's always a policy where somebody gets paid and somebody suffers. And in the world that we live in, savers have been punished and borrowers have been rewarded, and those who, with the intestinal fortitude to hold a 100% portfolio of stocks have been also very rewarded.
Yes.
Yeah. I get so frustrated, that you here are, it's a very small group of people that make choices. Here in the U.S. that literally affect billions. I mean, not only the 320 million of us that live in the U.S., but the effects are felt around the globe. And often for what purpose? Part of me gets cynical because certainly with QE. It's the ultra rich that have gained unbelievably through the increase in asset prices. Because the money hasn't landed on the street. I had an argument with a rep from the Fed in a public meeting on this early on in the QE program, and he kind of hummed and hewed and hawed back and forth, and then afterwards I went and grabbed him, and he goes, he says, "You're absolutely right." And I said, not a dollar of this ends up on the street. And all you're doing is driving inequality. So when, especially from a left perspective, people are talking about redistributionism, etc., that you guys are the ones causing the problem, you being the Fed, because the political left, which complains about capitalism or whatever, well, you guys are the source of the problem. Because what you're doing is you're driving asset prices through the roof, which helps those people who already hold those. I am not for redistributing income, but I am for a level playing field. And this is not a level playing field. And the guy from the Fed said to me, looked at me, he says, that's a brilliant analysis. He used the word brilliant. I thought, well, but why didn't you say that in public? Well, obviously because they're cutting their own throats. But you are giving ammunition to the very people that you do not agree with. Well, you guys are giving them the ammunition. Yeah. Anyway.
Great.
So, like in terms of Federal Reserve policies on interest rates, are they behind the curve? And how is this going to affect the balance sheet? I mean, there's talks of unwinding of the balance sheet, and what are we looking at in that regard, Peter?
Well, if you ask them, they're right on target. If you ask anybody not associated with the Fed, and they'll say they're well behind. I mean, it was Greenspan that started with this experiment of negative real interest rates and having the Fed funds rate below the rate of inflation. Where up to that point, the Fed funds rate historically was about 200 to 300 basis points above the rate of inflation. So if you're talking about history, and if inflation's running, let's just say 2% right now, well, historically, the Fed funds rate would be 4 to 5%. The problem, though, is that the enormous amount of leverage that has been built up in the financial system, getting to that Fed funds rate would literally blow up the system. So the question, therefore, is, okay, well, where the Fed funds rate should be now in light of that? Well, let's just get it to a zero real interest rate, and therefore you have a 2% Fed funds rate. Right now, they're at 0.875. I mean, one of the rules of central bank is you don't wait until after you get to your supposed mandate targets to then start normalizing interest rates. You should be at normalized interest rates when you get to your target. So it's clear the Fed is well behind the curve. They're just trying to. They've made up this wording, neutral interest rates, and it's only in the halls of academia does that term exist, and it's their way of rationalizing this very slow, gradual rise in interest rates because they believe that the quote-unquote natural rate, which really doesn't exist, it's pulled out of thin air, is somewhat low. Therefore, they can be slow with raising interest rates. And they believe that that natural rate will go up over the next couple of years, and they can follow that. But all they've done is rationalize to themselves this very slow pace because, you know what? They waited for the perfect world to NQE. They waited for the perfect world to raise interest rates, but none of that exists. And now they're stuck playing catch up.
Yeah, because the lapse rate, whatever, it is up to 2 years. So I'm totally with you, Peter. Totally true. I think they're way behind.
I mean, let's look at the thread, the needle of the thread that the needle has to get through right now, or say the thread that's going to get through that needle. Okay, so they want to slowly raise interest rates and keep everybody calm and not upset anything. But then that means they get behind the curve. Then they want to shrink their balance sheet nice and quietly, so don't be disruptive. But then they know, well, when we were enlarging the balance sheet, look how ebullient everyone got. So if we're going to see the reverse, maybe we're going to see the opposite effect. And then they want to normalize interest rates. At the same time, they created another credit bubble of epic proportions, and now is beginning to unwind, particularly in the auto sector. So somehow they got to pull that off. And then they realize that they've created this asset price bubble, which they even talked about in the minutes today about the high level of valuations, which it's always funny listening to them measure and analyze valuations. And they realize, okay, we created very high stock prices, and now we have to raise interest rates, and what's going to happen then? So good luck to them, because we all need it.
I mean, this discussion is so well said, but of course they will create every counterfactual. I love that, and then they send people out there in the media to talk about well, if we didn't do this, you know what? There was an ego involved that we can control this thing. They thought that they had silenced and slayed the business cycle, of course, which this all comes back down to. But the business cycle hasn't been slayed. It's all part of capitalism, and you have things that really they're going to hurt here and take place. And here's what their models don't tell them. And Peter and Uli are both right. Peter is much more right in the technical sense, because let me tell you what, when they go to if they were to actively start shrinking the balance sheet rather than passively, and they're still trying to determine, because they just don't know, and they can't tell anybody that they really don't know how this plays out. But I will tell you this, if they announced that they were going to be a seller of 50 to 70 billion which is not a lot. Not a lot. It will still take them quite a few years to shrink the balance sheet down to any level of sanity. But if they were to do that, all the people who've been harmed by the QE over the last 7 years, and there's been a lot of, the so-called bond vigilantes who actually served a great purpose in the market, because when the Fed got behind the curve, the bond vigilantes were there pushing the long rates, especially higher, to send a signal. But the signaling mechanism, as Rick Santelli and I have talked about for years already, has been broken by what the Fed has done. So there is no signaling mechanism. But I guarantee you this, if the Fed thinks that they can start selling assets and the market not get out in front of them and really punish them, they have no idea how markets work. None.
Well, they may learn in this fall, because from listening to Dudley on Friday and Harker on Monday, I'm getting the sense that so Yellen leaves in February 2018. You almost get the sense that she wants to ride off in the sunset with interest rates that are somewhat normal and the shrinking of the balance sheet underway, which implies that, based on what Dudley said, if they do it start by the end of the year, they want to get that third rate hike in this year by September. So we'll do it at the June press conference meeting, the September press conference meeting, and then maybe they start the process, the balance sheet process in December. Just imagine what markets are going to be like this August, September, October, which historically is always a bumpy road. And now we may get the third rate hike a month or two away from the shrinking of the balance sheet, and the ECB possibly getting closer to ending their QE. You better sleep well this summer, because it's going to be an interesting late summer, early fall time frame.
Wow.
Yeah, and all that assumes that the rest of the world narrowly goes along the way it has been. I think, I totally agree with you, by the way, with what you just said. It's going to be a crazy summer. But let's assume there's some ripple somewhere, and all those plans are thrown out. And, it would not surprise me if the outline you've just given, that is a strictly unilateral U.S. outline, but we're in a very interconnected market. So I'm not at all convinced it's going to happen. I think that's where we need to go. Don't get me wrong. I really think so. I think we're way behind. We should have, we got to go faster down that road. But boy, let's see what happens in Europe with the ECB stopping, and let's see what happens with China. I'll be very interested to see what happens over the next few days. But my job, how much will we actually know what said Mar-a-Lago?
Let me raise this issue though back to you, Peter. Okay, so let's say we start unwinding the balance sheet, okay, and they hold rates. That curve ought to steepen out quite a bit. Would you agree?
Yeah, on paper it definitely should, because you'll have one large buyer that's exiting the market on top of foreigners that are net sellers of U.S. Treasuries. So that should happen. I wonder, it'll start to happen, and then if people start worrying about what this is going to do to markets or the stock market, and that stock market starts to roll over, the economy starts to roll over, do you then get an actual flattening of the curve instead, because everyone's freaked out about growth?
Right.
I mean, that's the $64,000 question. So remember, when QE1 and QE2 were on with the purpose of lowering long-term interest rates, they actually rose because people believed in the reflation aspect of the QE.
Right. And that's it. That's the dilemma that we're going to sit in for what you portrayed coming to August, September. And Uli, when we talked last week, Peter wasn't involved in the conversation, but Uli, you were looking for the onset of a fairly significant global-based recession, if I'm not mistaken. You can correct me if I put words in your mouth, by December.
Yeah. That's right.
This yield curve, and Peter, I just sent you, it does get interesting, because if this curve does not steepen with everything that we talked about as a high probability, watch out, because it'll be a signal that there are many other things afoot here. So it's certainly worth watching.
I mean, look at, I want to talk about autos for a second, because well, we know the auto sector was a main driver of growth post-recession, and it's interest rate credit sensitive, second only to housing. And look what's happening in the auto sector. I wrote the other day that this is another sequel called Boom and Bust, and it was written, directed, and produced by Easy Money. And we now have the Fed, who may continue to raise rates, shrink their balance sheet. At the same time, the major driver of growth is now rolling over. Now, the auto sector itself can't necessarily put us into recession, but the ripple effects could be rather extraordinary. I think I read a statistic that about 4 to 5% of all jobs touch the auto sector in one way, whether it's direct or indirect. And this is the beginning. This is a big canary in the coal mine, I believe.
I can't agree with you more. And Uli, I know with your background in Austrian economics that this becomes very important, because what we just saw in the autos, and everybody forgets that we're not only at high auto sales, but we're at record repossessions of autos. Of course, you have the asset-backed security of auto loans, but it's the classic case in the Austrian sense of intertemporal misallocation, because through the use of credit, they keep borrowing all this demand from the future. And you know what? The future is now. And Peter, I think your point on the autos is so well taken. That is the canary in the coal mine.
Yeah. Back to numbers just for a minute. So let's assume that it's the 5% that you just talked about, Peter. So we have a consumer economy of 70%. 70 times 5 is 3.5%. That 3.5% tanks, that puts us into negative territory quite easily.
Right.
But this being monetary policy, how could this be affected, these type of scenarios, if there's a strong move on fiscal policy in the sense of announced infrastructure spending, or maybe to a higher level than announced, because it doesn't amount to too much, 100 billion per year. But if they actually announce and begin executing on a large infrastructure spending program, how would these scenarios be affected then?
Well, all we have to do is ask the Japanese about the stimulative nature of infrastructure spending. I think they've had 25 stimulus/infrastructure spending programs over the past 25 years.
Yes.
So that is not stimulative, because especially now when labor is relatively tight, who are you going to find to build that bridge? Well, it's not like all these construction workers are just sitting doing nothing. They're building other things. So if I have to pull a guy off a housing construction site because I want to build a bridge, well, the economy is no better off. It's just a transfer of resources. Yeah,
you hear the on my part, just a little bit. A couple of points. The infrastructure ultimately will create better productivity versus building an apartment building. Plus, I think our and again, I had an argument with this with another Fed guy. Our reliance on U3 numbers is really inappropriate in today's economy. I think the appropriate number is U6, which includes people who would like to get a job but who have not actively looked for a job over the last 4 weeks, because the U3 is the 4 weeks, and all of the people with multiple jobs, all of them part-time jobs. All of which they hate, and they'd love to get a real job. That's all included in the U6. It's not included in the U3. And so back to the argument I had with the Fed guy, and I said, that number, that is not today's number. That was 30 years ago. We lived in a U3 economy where people had stable, steady jobs, and you were employed by someone full time. We don't live in that world anymore. And therefore, what you should post is U6. He says, well, the two are parallel. Well, I don't care whether they're parallel or not. It's a phony number. And what's interesting is since 2007, U6 has not dropped. It's been around 10%. In last I think it's still 9.8%. So there's one heck of a lot of people out there, same with the participation rate, has steadily dropped, who would like to have jobs and said, screw it, I give up looking. I've set out 100 resumes. It's not going anywhere. I agree things are better today than they were 2 years ago. But there's still a huge percentage of the both male and female, 25 to 55, sort of the age range that we look at, who are not participating for one reason or another. And are they construction workers who could work on infrastructure right away? That's a different story. Let me, you guys feel free to comment on what I just said.
No, you're right. There is that underemployment that's out there. The question is, what will incentivize them to work? I think if most skilled laborers are already working, and
I think that's true. That's true.
Yeah.
So you need some skilled people to come off the sidelines. But even the U6 right now is about 9.2%. The average since the 90s is over 10%. So the U6, even though it's still very high, is not that out of the ordinary. In fact, I'm going back to 1994 was the earliest when they started calculating the U6, and the average since 1994 is 10.6%. We're at 9.2. So yeah, there is a group out there, but I don't think it's so excessive that you have this flood of labor coming back under the right circumstances.
Yeah, I mean, there's a secular decrease in the participation rate.
Yeah.
How that fits into the U6, I really don't understand, because that's a straight line, or it's some squiggle. Whereas U6, as you just said, is not, so because it hasn't changed dramatically. I don't know. Let me throw something else into the wind here. And I've been asked to submit some papers to the Trump administration on this. I propose using U.S. notes for infrastructure. So they're not part of the debt limitation legislation, and they create no real debt. They are non-interest bearing, non-repayable. And it in my mind, it's a heck of a lot smarter thing to do.
Who buys that paper? The Fed?
No, nobody buys it. It's created by Treasury, transferred into the account, Treasury's account at the Fed. So it creates no inflation whatsoever as long as it stays at the Fed. If you follow, right, you follow that jump. Is only once it is actually allocated to a particular infrastructure project. And my suggestion is you never use more than 80% of a project in U.S. notes, so that there's skin in the game for the local municipality or whatever it is that's building the infrastructure. Does that? I know I'm jumping very quickly here. This is what was used. There's still 238 million of them out in circulation today. I have one right here behind me. I have $5. Whenever I talk on this, you can see visually the difference. Federal Reserve notes all have green numbers, and U.S. notes all have red numbers. And the Fed stopped replacing them in 1971, which makes a lot of sense to me, because once they're in circulation, they are no different than any other U.S. dollar. It's just the way they are created is radically different. Our Federal Reserve notes, basically all of them, are created through debt. They're all driven by debt, whereas U.S. notes are not. They're driven by value. So it's a value-based currency versus a debt-based currency. That's one heck of a lot of information in 3 minutes.
Yeah, it makes sense. But we have to also remember the Congress passed a $300 billion, I think, infrastructure or transportation bill last year when right before Obama left. So,
right.
And the states are spending money every day on infrastructure. I mean, I live in New Jersey, and there seems to be road building every time I drive somewhere. So it's not like we're not spending money on this stuff. It's just happening. A lot of it's on the state level as well.
No, most of it is not on the federal level. I totally agree. So the point is to use federal U.S. notes to fund states and municipalities on a debt-free, interest-free basis.
Right.
That's the difference. So when you talk about the $300 billion Obama bill, the infrastructure bill, that's all debt-based money. So all of that money increases the 20 trillion, whatever number you want to use, the 20 trillion total versus where it's 13 or 14 trillion external that we have today. Let's call it 20 trillion. That's round number. That's the total. That's the total output in treasuries, whether they're owned internally or not. I have a website on this. You can have a look at it. It's called infrastructurewithoutdebt.org, where I go through the whole history. It's gone to the Supreme Court, how to do this. It is right now will be the new infrastructure report from the ASCE, the American Society for Civil Engineers, has just come out, and I haven't updated that yet. So they put one out every 4 years, and the last one just came out just a few weeks ago. So March 9th.
So the Treasury would hold this, and I have to think through this. It seems to be an interesting way to finance this deal. Peter, do you have anything else you see? This is
no. I mean, I haven't heard that form of financing. It does sound interesting, but my attitude with infrastructure spending, and you're right. Over time, we don't want to drive over a bridge that may fall, or we don't want to drive through potholes. And all you do is look at airports, and this stuff needs to be done. But we have to remember that there's nothing sustainable in terms of growth when there's money spent on infrastructure. It's only short-term in nature, and once the job is done, those workers have to find something else to do. So I'm just hoping that the focus on infrastructure spending doesn't distract us from how do we create more sustainable longer-term growth, and that gets done through tax and regulatory policy.
Yeah.
Yes, and on that sustainable long end, the one thing that Trump, to me, has talked about, and it's made a lot of sense, is to mimic the German model of, really training people so that they're just not going to one job and stopping, but to put them into apprentice programs and cut this nonsense about, you got to have a college education.
Right.
In Dudley's, if you want to see, it's interesting to me, a college education, because I've paid for 4 children to go through college, so I can speak somewhat intelligently from what I've seen. And if they talk about heuristics and, you can't really measure inflation, take Larry Summers, technology, what you buy today, there's so much more value, so you can't measure it. But when you look at the output from education, for the most part, it's hyperinflation, because I paid a hell of a lot more money for a lot less.
Out the kazoo. I totally agree with you. And you are so right. We do not all need university degrees, much as I have several degrees and all that kind of stuff. And I push my kids in the same direction. But I totally agree with you. If that's not your predilection, and for most people, or for a lot of people, it ought not to be. I love the German system, the whole apprenticeship, the using your hands and your brains combined.
I think I've seen estimates as high as 70% apprenticeship programs in Germany, relative to 10% in the U.S. I've seen estimates.
Yeah, I mean, if you're, this is going to be really crass what I'm going to say, but in the general American population, if you go into an apprenticeship program, you tend to be seen as a loser, which is really terrible, because that's so wrong.
Right. No, agreed. One of my daughters has a boyfriend who really wants to become a first-class welder and is working hard at it, because, hey, those jobs aren't going to be exported. I got news for you. There's a need for them, and to be a tradesman of that type of caliber, that's what Germany does well. They really train to be tradespeople, and there's a lot of pride to it. We haven't done that very well here. We've pushed college at everybody, and all it's done is multiply the debt levels exorbitantly, and not sure what else we have to show.
Yeah, very true.
Just a final question on trade policies with the new U.S. administration. Visit of China tomorrow. What are your thoughts, gentlemen, on trends in protectionism in the U.S. and maybe potentially overseas globally? Peter?
Well, I think there's the talk of protectionism because Trump and some of his people in his administration don't understand trade. They somehow see deficits as a negative. But if I'm a consumer in the U.S. and I can buy something cheaper overseas, that I'm actually better off. It actually improves my standard of living.
Yep.
And I understand the whole jobs thing and thinking that a higher deficit means that somebody else is making instead of us. But there's some things that we should make. There's some things that other companies in other countries should make.
Yes.
And what we have to do is make ourselves as competitive as possible, and let the chips fall where they may. So my concern is that Trump is taking this mentality of deficits bad, surplus is good, and then goes into a meeting with the Chinese with that somewhat ignorant mentality. We should be embracing the second largest economy in the world. We should be giving them a big hug because they are our partner in a sense of creating healthy, sustainable, quicker growth. But to battle with them over a trade deficit number, I think is just complete nonsense, because it's a misunderstanding of the benefits of trade.
Yeah, and Uli,
Yeah, on the current account, a bit broader than just the trade. Trade is a huge portion of it. I don't understand why the Trump cabinet doesn't seem to understand that the curse, so to speak, of being a global reserve currency is that you have to export dollars. You don't have a choice. Because so we have to run a deficit. We have absolutely no choice as long as the U.S. dollar remains as a global reserve currency, especially as other countries, because of the instability that is perceived, build up their U.S. dollar reserves. Well, they have to get dollars from somewhere. Well, there's only one place they can get them from, and that's us. And so, therefore, we have to run a deficit. It's utterly impossible to do anything else. So then let's not complain. Let's not complain if the yuan or whatever, some other currency becomes stronger from a global reserve perspective. That makes it easier for us then to not run a deficit. But I don't understand how they cannot link those two things together and don't see it. Especially the emerging markets have built up their dollar reserves on an astronomical level over the last 2 years because they've been afraid from a stability perspective. And so, well, like I say, they're not going to get dollars from Japan or anywhere else unless Japan already has the dollars. So, what am I not getting here?
Final thoughts, Ira, on that?
Well, Uli makes that point. And, Peter, you and I discussed that a few weeks ago with the whole BAT concept. When you are the reserve currency of the world, you have a different role to play, and you're not just like everybody else. So Uli's point is certainly well taken, and that was the basis of, as I'll call it, Pax Americana, which included Bretton Woods and everything else, the World Bank and IMF and everything that came with it, was that responsibility. Because instead of gold, what was the global currency became the dollar, and with that has come, again, the question is, are we, as Giscard d'Estaing says, it's an exorbitant privilege, maybe, or as Michael Pettis argues, it's an exorbitant burden. Either or, the world is in this situation. And if you were to rip that bandage off all of a sudden and say, no, we're not supplying dollars to the world, we will embark upon it, and I'm not mincing words here whatsoever, we will embark upon a global depression of such magnitude that it'll shake all of our teeth, and we'll all be in a situation that. So I'm 100% agreeing with it. You may want to roll back, and I believe that's what Trump's concept is. He wants to roll back Pax Americana and the cost of being an imperial America. I get that, but you better do it in a very measured way and in a timely way, because the Brits were able to get away from it, well, not easily at first in the early 1900s, but by the time they totally abdicated the empire and the role of the British pound, the Americans had already filled the void. You tell me who's going to fill that void if they go about this in too rash a manner.
Yeah, that's true.
But in answering about Xi, we know that one thing, that the Chinese will bring all types of gifts to placate Trump in the short term. We don't know what they are. I think that kind of pushed the stock market higher today in anticipation that there'd be some type of rational discussion, because actually Trump was very good today with the Jordanian king. Very presidential in the way he acted, which is, I think he's starting to understand certain things. But let's see what Xi brings, and let's see how those discussions go. And will there be a discussion about the Chinese currency? There's a lot of things that I want to wait and see before making any type of projections out of here.
Great, fascinating discussion. Great words of wisdom by everyone. Just wondering how our listeners can learn more about your work, Peter.
They can go to www.bookreport.com, BOCKreport.com, that's the best way. They can see me, or they can email me at peter@bookmarkadvisors.com, BOKMARK advisors.com.
Yep. And Uli?
At ulikortsch.com, so ULIKORTSCH.com. Or if they want to email me, they can just email Uli at ulikortsch.com.
And Ira?
Still Notes from Underground. And you can go to iraharris.com and find me there. And that's it. And I'll answer all questions that I find reasonable to answer.
Great. Thank you very much, gentlemen. Thank you.
Thank you.
Thanks for having me.
The FRA Roundtable Insight Show is for informational and educational purposes only and should not be considered as a solicitation or offer to purchase or sell any securities. The investments, investment strategies, and investment philosophies discussed or presented on the show each involve their own unique risk factors which are not discussed on the show. Any discussions among the panel participants or responses to listener inquiries are based on the personal opinions of the panel participants and do not take into consideration the listener's suitability, objectives, or risk tolerance. Please be advised that you invest or speculate at your own risk.